And so I am really not a book reader, and I really do not believe that books are that useful for getting rich. But there is one book that I read in 2019 that was such a big part of me making all the money that I did from crypto. And the book is called The Psychology of the Stock Market. It was written in 1912. So literally over 100 years ago, this book was written before TVs, phones, internet, all the modern luxuries that we have today. Before all of that shit, this book was written, and it is one of the most accurate representations and breakdowns of how markets work that I've ever read. And it helped me so much in my journey of making money from crypto, even though it's written about the stock market. That's the thing about markets, right? Doesn't matter if it's stocks, crypto, bonds, commodities, it could be any market in human history, could be the trading of fucking shells back in the caveman days. It really doesn't matter. All markets are dictated by the same emotions, the same biases, and the same driving factors for why price goes up and down. And it is because humans, regardless of the year, regardless of where they were born, regardless of what happened to them, every single human has the same base level programming that defines how they live every day of their life. And markets, even to this day, are largely traded by humans. And even if the markets today are traded by algorithms, they're still algorithms written by humans, so they're still biased to a certain extent from the human psyche. And so that's why this book is so useful. It was written based upon the same insights into the human condition, into the human emotions, the human programming that is still just as relevant today as it was 100 years ago. And so basically what I want to do is show you different sections of this book, which I found really interesting, and then give you a breakdown of that section and why it is important to understand. And so the first section basically says, when the markets look weakest, when the news is at its worst, when bearish prognostications are most general, is the time to buy. So it's crazy that when you think about it, every single market bottom since the dawn of human time, when humans were trading something with someone else, whether it's shells, gold, paper notes, stocks, in a physical trading environment, crypto on the internet, all of these markets have the same underlying driving factors. And one that has basically shown itself throughout time is that when the markets are weakest is the time when the bottom is in. So markets have always bottomed on peak fear. When the market is most afraid, most fearful, most negative and skeptical about the future, that is when the prices hit their bottom. And a perfect example of this is actually FTX a few weeks ago, basically going bankrupt and completely fucking with the crypto space, right? All these projects, all these funds, all these investors had billions of dollars on FTX, which they now has, gone into thin air, right? It's disappeared. And the market was so afraid during this FTX bankruptcy period that was why it was the bottom, right? If you look at when FTX went bankrupt, that was just before the bottom of the crypto market. Now, why is that? Well, markets bottom when they're most fearful. And so the most fear that this market has ever experienced is the second biggest exchange going bankrupt. That's bigger than the entire saga of the 3AC blow up, right? It's bigger than that. This exchange blowing up is 10 times bigger. And that's why this was where the price hit its bottom. And this has happened through every single bottom in history, right? If you look at where Ethereum bottomed at $80 in 2019, there was a classic bottom tweet by Meltem Demirors. And she said, asked a non-crypto trader to give me his take on the Ethereum chart. This chart is totally broken. Any rally will be pushed down with stiff selling pressure. Reminds me of when Lehman and Bear went down. And so this tweet is just a classic example of when someone is so afraid of the market that they will look at the Ethereum chart and say that the chart is broken. That is when you know that the fear is peaking, because they literally think the Ethereum chart is broken. Yet at $80, that was the lowest price it ever went again. And it went on to go to several $1,000s. So that doesn't sound very broken to me. That is just how markets work. When the charts look their most weakest, that is when it is the time to buy. And so the second section says, when prices get above the natural level, a well-judged short interest begins to appear. These shorts are right, but right too soon. The thing is that in bull markets, prices will go on higher than they are expected to. Every single time. That is just how bull markets work. So the problem is that a newbie trader will load up a chart of the Bitcoin chart. They'll see that the RSI is really high. It's at like 90. MACD is really high. And they'll just tell themselves, price can't go higher. It's overextended. I have to sell, I have to short. And they'll try to short the market and they'll get fucking wrecked, because prices can continue to be irrational for longer than you can remain solvent. Now, that is a famous investing quote that is similar to what the book is trying to say here. When prices get above the natural level, meaning they become overvalued, a well-judged short interest begins to appear. And these shorts are right, the price is overvalued, but they are too soon, because there is no such thing as easy money in markets, really. If you're trading, the market is going to go in the direction with which it will fuck over the most amount of people. That is guaranteed. And so when the price goes up a lot, people start to short a lot because they go, oh, price can't continue going up. All the shorts come in, and the market sees that there is a big short interest, there is a big level of liquidation, and then prices will continue up to basically shake out the shorts. And so when these shorts actually get liquidated, it is only then that price can actually go down, because it always moves in the direction that'll fuck over the most amount of people. So when price goes up, liquidates the shorts, then price can go down, liquidate the longs. It's always this constant pattern of this. And especially in bull runs, price will just continue higher, liquidating as many shorts as it can, which is actually fueling the fire of the rally, right? Because the thing is, every closed short is a buy. So in bull markets, all these people are trying to short against the trend, and we also have a lot of buyers coming in. And when you combine heavy buying power with shorts closing into an already illiquid market, you have basically the setup for a crazy parabolic rally, right? Because you've got two types of buyers. You got buyers who want to buy, and you've got buyers who don't want to buy, right? The shorts closing don't want to buy, but they have to close, they're short, or they're just going to get totally wrecked. Or they got liquidated and they have no choice and they have to buy anyway, right? And so that's what causes these sort of short squeezes, is what they're called, where it's because when shorts close, price goes up because they have to buy, and because price went up, more shorts close. And then those shorts have to buy. And it's this like feedback loop of continually higher prices liquidating more and more shorts. This is basically what this section is explaining. And so this next section is really, really interesting. A small quantity of stock pressed for sale in a panicky market may cause a decline out of all proportion to its importance. The offerings may be small, but nobody wants them. It is this factor which accounts for the rapid recoveries which frequently follow panics. Waiting investors are afraid to step in front of a demoralized market, but once the turn appears, they fall over each other to buy. And the boom is in many ways the reverse of the panic. Just as fear keeps growing and spreading until the final crash, so confidence and enthusiasm keep reproducing each other on a wider and wider scale until the result is a sort of hilarity on the part of thousands of men, many of them comparatively young and inexperienced, who have made big money during the long advance in prices. And so what this whole section is trying to say is basically, when the bottom appears, everyone is too afraid to buy because the market is just completely destroyed. And it is only when prices begin to go back up that people start considering to buy. And that's why when you have the bottom in, the rally from the bottom tends to be quite aggressive, because people en masse are realizing, oh fuck, I missed the bottom, and they're all buying back in after the market has already risen, and it causes this short squeeze, panic, greed, market buying movement higher, right? And so this is what you need to look out for in markets, right? When we hit the bottom in crypto, if we've already hit it, what you should see is a demoralized market, firstly, and secondly, when the market begins to go up, people being in denial and also thinking, oh shit, that could be the bottom. Ah, fuck, that could be the bottom. I might have to buy. What if I've missed the bottom? Oh my God, the Fed has stopped raising interest rates. Oh shit, the economy's stronger than I thought. Oh no, the bottom might be in. When people start thinking like that, that's when you know it's the bottom. And that's why it's so important to buy when people are fearful, because when the market is fearful, that is when you have people waiting on the sidelines and when people are most afraid to buy. When you make money in crypto, you are being paid to take the side of the market which people were too afraid or too greedy to take, right? If you bought at a low price and price is now higher, you're getting paid for the risk that you took on, which was buying when people were too afraid to buy, right? Because if let's say last week you bought a coin at $1 and now it's at $2. Last week, there were people too afraid to buy at $1 who are now comfortable to buy at $2. And they are paying a premium for the added confidence they have behind buying that coin, right? When price goes up 1,000% and people now feel comfortable to buy, they are paying a higher price for the confidence that they feel in themselves in the decision that they're making. So when you buy when the market is fearful, you are getting a discount for buying when the market is fearful. And so this next section is how you can pick the top of the Bitcoin bull market. So eventually a level is reached or some change in conditions appears, which causes these scaling buy orders to be partially or entirely withdrawn and selling orders to be substituted on a scale up. And the bull market will not go much further after this change takes place. It has now become easier to produce declines than advances. The situation is the reverse of that described above. So basically what this is trying to say is that the bottom is in because there is two types of coins in a market, right? There's the coins that are on the exchange, and then there's the coins that are basically locked away. Let's think of two examples. There's two coins, right? Coin A and coin B. If coin A has 50% of its total supply on the exchange and 50% off the exchange, and let's say coin B has 2% of its coins on the exchange and 98% off the exchange, right? Which coin will be easier to move up in price? Well, it's obviously going to be the coin which has 2% on the exchange, because if you want to push price up, you only have to buy a very small amount of those coins to push it up, because most of them are locked away. And yeah, of course, the price might double and it might seem overvalued, but as long as those coins over here stay locked away, the price can remain higher in this 2% that is on the exchange. And so what this section of the book is basically explaining is the inverse of what I just said. When the market is rallying, the bull market's on. The top for this market is in when these investors who have bought coins off the market at low prices, who are holding like most of the supply, when they get bearish and they decide they want to sell, they're moving coins from locked storage onto the exchange. And it is increasing the total amount of coins, the total float of coins on the exchange. And that is bearish because the more supply that is readily available to be bought and sold, the harder it's going to be to move price up. Because when 98% of the coins, like with coin B in that example, are locked up, those coins almost don't exist because they're locked away. You can't buy these coins, they're locked away. So they almost don't exist, right? It's easier to push the price up when barely any of that project is able to be bought. And so when that supply gets unlocked, brought back over and sold, the total float increases. That means supply is higher. If demand's the same and supply is higher, price will fall. And that's what ends bull markets. And so the next section basically states, in the market, you are nothing but a chip on the tide of events. Optimism, then, must consist in believing not that the tide will continually flow your way, but that you will succeed in floating with the tide. Your optimism must be, in a sense, of the intellect, not of the will. So basically what this is trying to tell you is that you can't buy shit coins hoping to get rich. This is genuinely the investing strategy I've seen some of you guys have. You message me and you're like, okay, so my plan to make 100x from the market is I'm gonna buy 50 coins, 50 random projects which look cool. I'm gonna put $100 in each. And then basically half of them are gonna go to zero, or most of them are gonna go to zero. And I'm just gonna sell the ones that go 100x and take my profits. When someone says that to me, I'm just like, this is the most gambling approach I've ever seen. Spread betting is not investing. It is gambling. And being optimistic that you will make money in the market, if I just buy these coins and wait for the bull market that's going to come, I'll just make money. No, it's bullshit. That's not how you approach market. It's not about being optimistic the tide will flow your way. It's that you will succeed in floating with the tide. So you have to be able to know when the bottom is near, when the top is near, through your own system. And then you need to be able to act upon that and buy sound projects that have a promising future. And once you've done that, you know what to buy, and when to sell. You will be able to flow with the tide. And then you can basically expect to make profits over the long term. And so this next section is very similar to the last one. It basically says, another quality that makes for success in nearly every line of business is enthusiasm. For this, you have absolutely no use in the stock market. The moment you permit yourself to become enthusiastic, you are subordinating your reasoning powers to your beliefs or desires. Enthusiasm helps you influence other men's minds, but in the market, you do not desire to do this unless you happen to be a big bull leader. You wish to keep your mind as clear, cool, and unruffled as the surface of a mountain lake on a calm day. Any emotion, enthusiasm, fear, anger, depression will only cloud the intellect. And yeah, this one's pretty self-explanatory, but basically, you don't want to have emotions when you're investing and trading. Emotions affect your ability to make logical decisions, and if you can't make logical decisions at the highest degree of accuracy, you will make the wrong decision and you will lose money. See, emotions will tell you that you don't need a stop loss because the price is definitely going to go up. Emotions will tell you that a coin is up 50% in a day and you should buy. Emotions will tell you that the market has dropped 50% and you should sell now because you have to sell after the market's dropped before it goes to zero. Listening to emotions causes you to make those decisions, which are only going to make you lose money. And so the final section, which is my favorite by far, is basically it says, extreme prices will come at the time when the news is most emphatic and most widely disseminated. When that point is passed, the question must always be, what next. Now, I think about this section probably every week. Not this exact quote, of course, but this line of thinking I think about every week because it's really important for markets, right? Right now, we all want to buy the bottom. That's what we're here for. Right now in the market, it's bear market. We just want to buy the bottom so that we're ready for the next bull run. That's what everyone wants. And the way you do this is basically the point where the price is at the bottom is when the negative news that is known in the market is most widely spread. Because if the price is going to go down, it requires people to sell now and into the future, right? Price will only go down if there are people who haven't sold. And so if everyone in the market has already sold, who is going to push price down? And so imagine it this way, right? There's a room and there's 100 people in it. 50 people are on the left side who are bullish and 50 people are on the right side who are bearish. Now imagine we tell the room that FTX just died and they went bankrupt. What happens is that you'll find that all the people on the bullish side will pretty much move over to the bearish side. And maybe 2 people will remain on the bullish side and in fact will double down on their conviction of bullishness. And so when everyone knows the news about FTX dying, crypto being bearish, regulation coming, get out of the crypto space, when all the 98 people have gone to the right side, there is no one left to sell, right? The only people who could possibly sell are those 2 dudes who doubled down and bought more at the bottom. So that's basically what happens when the news is most widely disseminated. Everyone who was going to sell based on that news has already sold. No one is going to sell a week later because, oh shit, FTX came out, I need to sell now. No, people sell when the news comes out or just after it. And after it's a week later, no one is selling based off old news, okay? It's old news, no one cares. So that's something to keep in mind. When everyone knows the bad news or the good news of what's happened in the market, it's already too late to act upon it. And so if you found this video interesting, let me know in the comments below because it was a bit of a different video. I have 2 more investing books which completely shaped my investing, which I can make a video on as well. And I've also made my own version of Psychology of the Stock Market. This book is called Psychology of the Crypto Market. It's a 100% free guide. You can read it below. Highly recommend it, and I'll see you guys in the next video. Thank you for watching.